Private companies versus public companies. Understanding the difference. Think of a company like a shop. A private company is like a family-owned shop, with a few owners and limited access for others. A public company is like a big supermarket listed on the stock exchange, where anyone can buy a small piece or shares. Private companies are like closed clubs. They have a limited number of owners or shareholders. These companies are not listed on stock exchanges and have less regulatory scrutiny. On the other hand, public companies are open to the public. They list their shares on stock exchanges through an initial public offering, or IPO. This allows anyone to buy shares and become a part owner. Going public can bring several benefits for companies. It allows them to raise capital for expansion, enhance their brand visibility, and provide an exit strategy for early investors. The journey to the stock market, from private to public. Getting listed on the stock market is a complex process for Indian companies. It involves several steps and regulatory approvals to ensure transparency and investor confidence. The first step is to get approval from the Securities and Exchange Board of India, or CBI. SEBI is the regulatory body that oversees the Indian capital markets. They scrutinize the company's financials, business model, and management team. Once SEBI gives the green light, the company needs to meet the listing requirements of stock exchanges like the National Stock Exchange, NSE, and Bombay Stock Exchange, BSE. This includes meeting minimum net worth criteria, profitability standards, and corporate governance norms. IPO decoded. Understanding how companies go public. An IPO is the process through which a private company sells its shares to the public for the first time. It's like opening the doors of the supermarket and inviting everyone to become a shareholder. Companies work with investment banks to determine the initial price of their shares. This is influenced by factors like the company's financial performance, market demand, and industry peers. Zomato, the popular food delivery app, and Nykaa, the online beauty retailer, are recent examples of successful IPOs in India. Both companies witnessed significant investor interest, leading to a surge in their stock prices on listing day. Beyond IPOs. Exploring direct listings and SPACs. While IPOs are the most common way for companies to go public, there are alternative routes like direct listings and SPACs. In a direct listing, a company bypasses the traditional IPO process and lists its shares directly on the stock exchange. This method is faster and cheaper, but offers less control over the share price. SPACs, or Special Purpose Acquisition Companies, are shell companies formed to take private companies public through mergers. They offer a faster way to go public but have faced criticism for their complex structure and potential for conflicts of interest. Navigating the stock market waters. Once a company goes public, its shares start trading on the stock exchange. The share price fluctuates based on various factors like market sentiment, company performance, and industry trends. Public companies have ongoing obligations to their shareholders and regulators. They need to disclose financial information regularly, comply with corporate governance norms, and maintain transparency in their operations. Going public is a significant milestone for any company. It opens up new avenues for growth, enhances credibility, and provides investors with an opportunity to participate in the company's success story.